Hey guys, welcome to my channel. Today's topic is monetary policy. So let's discuss about what is monetary policy. Monetary policy is an economic policies that will manage the size and growth rate of money supply in the economy. So this monetary policy will tell us what should be the money supply, how much should be the money supply in the economy, and it is a powerful tool to regulate the microeconomic variables such as inflation and unemployment will be regulated with the help of monetary supply. These policies are implemented through different tools, including the adjustments of interest rate, purchase or sale of securities, and changing the amount of cash circulating in the economy. The central bank is a regulatory organization of the monetary policy. So, what is the main objectives of the monetary policy? The main objectives of monetary policy is the management of inflation, unemployment, and the maintenance of currency exchange rate. So, how unemployment will be managed with the help of the monetary policy committee. Monetary policy can influence the level of unemployment in the economy. For example, if the monetary policy expands, it will decrease the unemployment rate, because if there is a money supply in the market, it will stimulate the business activities, which will lead to the expansion of job market in the economy. So through this, the unemployment will decrease with the help of the monetary policy. What is inflation? Inflation is the increasing in the prices of goods and services is called inflation. So through the help of monetary policy, the inflation can be controlled through the monetary policy. Currency exchange rate. What is currency exchange rate? Using its fiscal authority, a central bank will regulate the exchange rates between domestic and foreign currencies. So how the rate should be there between the domestic and foreign currencies is done through the currency exchange rate. For example, the central bank may increase the money supply by issuing more currency notes in the market. If this is the case, what will happen is the domestic currency will become cheaper than the foreign counterparts. So these are the objectives of the monetary policy. What are the instruments of monetary policy? So let's discuss in details each of the instruments of monetary policy. There are several direct and indirect instruments that are used for implementing monetary policy. First one is repo rate, second one is reverse repo rate. In the repo rate, what happens is the bank will take the loan from the Reserve Bank of India against the collateral of government or of other approved securities under the LAF facility. So in repo rate, this is the rate through which the bank will take the loan from the RBI, and in the reverse repo rate, it is also the rate through which the Reserve Bank will take the loan from the banks. Why the Reserve Bank will take the loan from the banks? To absorb the liquidity in the markets. To absorb the liquidity in the market, the Reserve Bank will be taking the loan from the banks against the collateral of eligible government securities, and this will be also done on the liquidity adjustment facilities. So this is repo rate and reverse repo rate. What is LAF? LAF is liquidity adjustment facilities. The name itself says us how the liquidity will be adjusted through this facility. So this is called liquidity adjustment facility. And this is a tool which is used in monetary policy mainly. Who will be using the monetary policy? Reserve Bank of India, which enables the banks to borrow. In this, the banks will be borrowing money through repo rate, or the RBI will be borrowing the money through the reverse repo rates, through which the liquidity will be adjustment. Liquidity gets adjusted through this LAF facilities. What it does is this arrangement manages liquidity pressures and ensures basic financial market stability. So if this liquidity adjustment facility is conducted, the basic financial market stability will be provided in the market. The Reserve Bank of India also transacts depositories and reverse repo within the open market operation. The Reserve Bank of India does this. What is MSF? MSF means the marginal standing facility, a facility under which scheduled commercial banks. In this, what happens? The scheduled commercial banks will borrow the additional amount only for a overnight period from the RBI. But so this is called a marginal standing facility. By dipping into their statutory liquidity portfolio up to a limited penal rate of interest, this provides a safety valve against unanticipated liquidity shocks to the banking system. If there is a unanticipated liquidity in the banking system, the MSF facility will be used by the banking system to borrow the money from the RBI, and but this facility is provided only for an overnight period of time. This is called MSF. What is corridor? Corridor is the difference between the reverse repo rate and the marginal standing facility rate. So what is the difference between the reverse repo rate and the MSF rate is the corridor. What is bank rate? It is the rate at which Reserve Bank of India is ready to buy or rediscount bills of exchange or other commercial papers. So in this, what happens? The Reserve Bank of India will buy the securities, or it will rediscount the bills or commercial papers from the bank. So that is called the bank rate. So at this rate, at the bank rate, the Reserve Bank of India will rediscount the bills or other commercial papers or government securities it will buy from the banks. And this bank rate is published under Section 49 of the Reserve Bank of India 1934. And this bank rate is aligned to MSF. If MSF increases, bank rate also increases. Currently, both bank rate and MSF rate are the same. Therefore, changes automatically. So, this MSF and bank rate remains the same. If bank rate changes, MSF also changes along with the policy repo rate. What is CRR? CRR is nothing but cash reserve ratio. Here is cash will be reserved by the bank. Here cash will be reserved by the bank with the RBI. So how much cash will be reserved by the bank with the RBI? It will be the average daily balance that a bank is required to maintain with the Reserve Bank as a share of percent of its NDTL. NDTL means net demand and time liabilities. A certain percentage of amount will be reserved with the Reserve Bank of India, that is called cash reserve ratio. And this CRR ratio will be notified from time to time by the Reserve Bank of India to the banks. What is SLR? Statutory liquidity ratio. It is also the percentage share of NDTL. Out of the NDTL, the bank is required to maintain its safe and liquid assets such as government securities, cash and gold. The SLR will be in the form of securities, cash and gold, but the CRR will be in the form of only cash. Changes in SLR often influences the availability of resources in the banking system for lending to the private sector. So if SLR changes, based on the changes in the SLR, the bank will decide how much to lend to the private sector. So this is called SLR. What is open market operation or OMO? Open market operation. In this, the selling and purchasing of securities or bills will be done by the central bank of any country in order to regulate money supply in the market, in the economy. So in this, what central bank does, they will be selling as well as purchasing the government securities from the bank, so that money supply is in the economy is regulated. In this, what happens is the central bank will sell the securities. Why it will sell the securities? When it wants to reduce the money supply in the market. If it wants to reduce the money supply in the market, it will sell the securities. When it sells the securities, the monies will be in the hands of the RBI. So this is called contractionary monetary policy. And similarly, when the central bank wants to increase the money supply in the market, what it does, it will purchase securities from the market. When it will purchase the securities from the market, the money will be the money will be injected into the market. So this step is taken to reduce the rate of interest and also helps in economic growth of the country. This policy is known as expansionary money supply. And the next is, what is MSS? MSS is Market Stabilization Scheme. In MSS, it is also a monetary policy intervention by the RBI to withdraw excess liquidity or money supply. If there is a more money supply in the market, the RBI will conduct the market stabilization scheme operation. What it does is, it will sell the government securities in the economy. When it will sell the government security in the economy, it will be purchased by the people. And so all the money, if there is excess money in the market, the money will come to the RBI. And this was introduced in April 2004. The main thing about MSA is that it is used to withdraw excess liquidity or money from the system by selling government bonds. So in this, what does the government bonds will be sold by the RBI, and the excess money will be taken by the RBI. What is PAN? PAN is a permanent account number, and it is a number issued by the income tax department. What is plastic money? Plastic money, like we have plastic money such as credit card, debit card, ATMs, and international credit cards issued by the banks. All these are called plastic money. What is point of sale? Point of sale refers to a location at which payment of a card transaction occurs. Here, card transaction payments will take place at the point of sale. What is prime lending rate? So the rate of interest at which banks give loan to its most reliable customer. Prime means giving importance to person, giving first priority. Prime lending rate. So in this, what bank does is, it will be providing loan to its most reliable customers. So this is called prime lending rate. What is STR? STR is a reserve asset or paper gold which is created by the International Monetary Fund to increase the international liquidity in the market. What is teller? A teller is a staff member of the bank who cashes checks, accepts deposits, and performs different banking services. What is universal banking? When financial institutions, banks undertake activities related to banking like investments, issue of debit and credit card, then it is known as universal banking. What is virtual banking? Internet banking is sometimes known as virtual banking, and this is mainly controlled by the World Wide Web. What is wholesale banking? It is similar to retail banking with a slight difference that it mainly focuses on the financial needs of institution, clients, and industry. This wholesale banking will not consider the individual. It will mainly consider about the institutional clients and industry. Thank you guys. This is for today. See you in the next class.